Welcome to The Business That Pays with Adam Tolliver from Artisan Financial Strategies, where we mind the business that pays you. In this podcast, we empower successful families and business owners to make informed decisions about their finances through courageous conversations. Through his expertise as a practicing investment advisor representative with Eagle Strategies, LLC, a registered investment advisor, Adam teaches you how to create a wealth ecosystem by combining a practical technical framework with your personal, family, and community values. Join us for this journey where Adam normalizes sustainable wealth building and gives you the keys to make courageous, proactive financial decisions.
Welcome back to the Business That Pays podcast. This is the second of a four-part series in which host Adam Tolliver dives into his financial philosophy. Now, in the first episode, Adam talked about money and its relationship to time. This time around, it's money and function. I'm Patrice Sikora. And Adam, let's set the stage with an explanation of what you mean when you say function.
Thank you so much, Patrice. So as you mentioned in our last episode, we talked about money as a function of time, and we talked about money in relation to time. And we discussed two sort of critical questions that we want to ask ourselves when we're deciding where we're going to place our money. When do I need this money? That's time. And then what will it do for me between now and when I need it? And that's where we start to get into function. You hear people say things like, I want my money to work for me. I want to make sure that it's, doing something for me. Well, this is what we want to get into. What can money actually do for us? So I believe that there are three core functions that money's going to serve for you in your financial plan. And what's important to understand is that there are pros and cons. As one of my mentors always loves to say, for every gimme, there's a gotcha. So there's pros and cons for each of the functions. And so we want to talk about those.
Do these functions fall into the different phases of the life cycles that we've been talking about, or do they just play a role throughout your entire life?
They do play a function. They play a role throughout your entire life. And what happens is we're sort of recalibrating how much we need each function to be served through the various life cycles. So as your family's growing older, as you are maturing through your career, as you're preparing for retirement, and as you're getting older in age, all of these phases are going to interact differently with what you need out of these functions.
All right. Well, let's start with, of course, liquidity. Everybody wants to have access to their money.
Yes, this is function number one. And this is really what I would say most people are going to be able to grasp readily because they use it every day. This is the way that most of us interact with money on a regular basis. Liquid, accessible funds. We're talking about your savings account. We're talking about your checking account where you swipe your card. This is all about money that you need access to right now. It's how you pay for your food when you're going through a drive-through. It's how you pay for your groceries at the grocery counter. And of course, some people may use credit, but even with credit, it's short term and you're going to pay it off, relatively soon. So we're still talking about accessible funds, money that is readily available. These actions are really most closely associated with our immediate and short-term needs. So when we're thinking, going back to last episode, talking about money in relation to time, our short-term funds need to be liquid and accessible. And so even if you're thinking about putting money aside for, say, an emergency, so your emergency fund, you want it to be liquid because if there's an emergency, you need the money immediately. The drawback to having too much money in an accessible or liquid place is that typically the more liquid and accessible something is, the less likely you are to get any sort of return on those funds. And so, your savings account, unfortunately, is not paying a great interest rate. 30 years ago, that would have been not the case. You could still get good interest on a savings account or a CD
Not
or
these
something
days.
like that.
No.
And so that's a price that you're willing to pay, essentially. We think about inflation, and inflation can be running anywhere from 2 to 3%. Well, if you have too much money sitting in a savings account, over time, that money is essentially losing to inflation. You're losing purchasing power because you're earning less on your money than inflation. You're willing to pay that price for the short-term security. And so that's the gotcha to
Mhm.
the benefit of having liquid and accessible cash.
Now you said too much. How do you determine what is too much?
Funny enough, we go back to our first pillar, understanding our money relative to time. A rule of thumb that is very popular and I think makes a lot of sense is to think about it relative to how long you can last on a certain amount of money. And so historically, people will say 3 to 6 months of your expenses. So, God forbid, if for some reason you were unable to earn your normal income for 3 to 6 months, you would be able to cover all of your expenses and maintain your existing lifestyle for that amount of time until you can move into something else. This may vary based on the nature of your income. So if you are, say, a commission only type of earner, and there may be huge spikes and valleys in your income, you may want to have a few extra months if possible, just to give you a little bit more leeway. But the idea there is still just thinking, how long can I continue to function the way that I currently am, the way that I'm accustomed to with this money? And then once we get beyond that point, that's when we're thinking, okay, if you're comfortable with 6 months, once we've got 9 months, 12 months, 15, 18 months worth of money in liquid accessible, you're probably running the risk of having quote unquote too much money
Right.
readily accessible. Now, that's going to vary. You may be in a position where you're about to make a down payment on a house or pay for a wedding or, or any large
Mhm.
purchase that may be on the horizon, in which case you're going to want a little bit more accessible and liquid than normal. But generally speaking, if you don't have something like that on the horizon, that's where we want to start looking to figure out how we can get into these other two functions that we're going to go over for your money.
With the clients that you've seen, how long does it take someone to amass a 3 to 6 month cushion?
It varies, and this goes back to a concept we also spoke about in the last episode, in that cash flow is king. So if you are in a position, and this just may be a function of where you are in your life, if you're still a recent graduate and you've got a lot of student loans and you've got, some credit card debt or whatever it might be, you may be in a place where you don't have a bunch of free capital to dedicate towards your savings. But your cash flow is going to really determine how quickly that can happen. And
Right.
so everyone of course is starting from a different place, but just a reminder, your cash flow is the difference between your monthly income and your monthly expenses, and what you have left over is that free cash flow that we can make decisions about how aggressively we want to put aside to hit those goals as far as emergency funding goes.
Should you be pretty aggressive about getting this emergency funding together?
Yes. And this is something that it is very easy to say if you are not facing a mountain of debt, for instance. What most people will want to do if they've got credit card debt, student loan debt, personal debt, they want to throw as much money as they can at their debt to pay it off as quickly as possible, which I completely understand. The danger that you run if you are not also keeping cash on hand is if something does not go according to plan,
Mm.
and you don't have any cash cushion there, then you're just going to end up dipping back into your credit and running it back up anyway. So, something goes sideways and you've been throwing all your money at your debt, and suddenly you've got an unexpected expense and you have no cash. You're going to have to swipe your card again. You're going to have to take another loan, etc. So you need to be able to sort of serve both of those purposes with your cash flow.
Does this then run into the second point you want to make here, protection?
A little bit it does. So protection is the second function for our money. We use our money to protect the rest of our assets, at least a portion of it, right? So as we are, and this is something that people don't always realize they're doing. Some of it is involuntary because we're more or less forced to by the law. So if you own a home, you have homeowners insurance. If you drive a car, you have car insurance. The idea of this is to take a portion of your income and cash flow to protect yourself from potentially catastrophic financial events that would be very difficult to pay for out of pocket. So, most people have enough money. If you own a house, you had enough money to buy your house. You might not have had enough money to buy your house twice. So if
Right.
it burns down, you need some sort of financial protection that could help you recoup the value that you would lose, as opposed to trying to pay to rebuild your current house or buy a brand new house. Same thing with a car. You may have enough money to cash flow one car. You may not have enough money to duplicate your existing car. So you use insurance to make up the gap to protect yourself in the event that something happens to the car. Beyond that, we're also talking about intangible things like your income, which is hard to really nail down, but you protect your income with things like life insurance and disability insurance. God forbid. And we think about this, it's never a fun conversation, but it's something that needs to be discussed. If you are in a two income household and you've built your entire lifestyle around a two income household, and especially if you have children who are dependent on both incomes, if something happens to one of those breadwinners, how will the family continue to function financially if that one income is taken from a two income household?
Mhm.
So that's where we use life insurance and disability insurance. So we can use our money to protect our families, to protect our income, protect our health, and protect our property. And that's where protection comes into play. The drawback when it comes to protection, well, our good friend liquidity that we love so much, having access to our money, we are now taking away from our liquidity through paying for premiums. And there are some ways that we can get, and we'll talk about our next function here. We can get sort of a double function out of protection in
Mhm.
some cases, but usually you're going to have to give up some liquidity in the short term in order to have that peace of mind and protection. So you're peeling off some of your cash flow to protect the rest of the big picture. And that, that
Mhm.
can be difficult to wrap your head around, because it is sort of a I only get my value out of this if I have a bad day type of situation.
Right.
So
Which opens the window to, okay, yes, it does sound like you can have too little protection, but can you have too much protection? Could you be basically wasting your dollar earning power?
you absolutely can. And that is why it's important whenever you're looking at a protection plan, any type of insurance plan, you want to audit it and review on a regular basis. At least once a year, you need to be reviewing your insurance portfolio, your property and casualty, your life, your health, your disability, whatever insurance you're paying for. Life happens, life changes.
Mhm.
And what made sense for you 2 years ago, 3 years ago, 5 years ago may not make sense now. So you don't want to continue to pay unnecessary premiums when those dollars could be going towards another function that serves you better. And really, that's just a product of managing and paying attention to how much exposure you actually have to risk. For instance, some people in certain professions are more at risk to, say, a disability claim
Sure.
than others. So just being mindful of like where are my true risk financially, and how does that play in? So so yes, you absolutely can have too much protection.
And this also goes back to something we mentioned in the first episode on time. You've got to be diligent about making sure you review your holdings on a regular basis with your financial advisor.
Absolutely. 100% necessary. And I always tell people, again, we are building a framework by which we make decisions, but it's flexible in nature because your life is. And what that requires is that we've got to keep our eye on things. And the more time we distance ourselves from the initial decision, the less relevant it becomes to your life. So we need to keep an eye on it because it's a living and breathing plan, the same way that your life is a living and breathing experience.
Mhm. All right. And the third point here in understanding your money relative to function is growth and accumulation. Now, this sounds good. Everybody wants
Yes.
growth and accumulation.
Yes. Listen, I would say about 90% of the people who reach out to me for our first meeting, we have a nice little intake questionnaire and says, what made you reach out to a financial advisor? And say, I want to know how to grow my money.
Yep.
I want to make sure that I'm growing my money. So this is the sexy one of the three functions. The very stale and unsexy and boring purpose of growing your money is to outpace inflation.
Right.
Nobody thinks about it that way, but really, if you're trying to grow your money for the long term, part of what you're doing is making sure that the future version of yourself has the purchasing power to survive.
Right.
And so we talked about inflation when we talked about liquidity and accessibility. And so if inflation is happening at anywhere from 2 to 3% over the long run, you need to be able to put your money in an environment where it can grow by more than 2 or 3%. That way, when your 30-year-old self gets to be your 50-year-old self, or your 60-year-old self, or your 70-year-old self, that money actually still has relevant buying power to where you are in your life. And that's where we want to get our growth and accumulation. To make this tangible, this is why your retirement plan, your 401k or your IRA, or if you work for a nonprofit, maybe it's a 403b, but the
Mhm.
money that you have earmarked for retirement is typically going to be in investments, because investments is the place where you're most likely to outpace inflation on a regular basis. So you can be more aggressive with it, going back to episode 1, because time wise you're looking down the road. The
Mhm.
further out, the more aggressive we feel comfortable being, because you have time to sort of withstand the volatility that you'll experience in the short term. So growth and accumulation, this is where we want to create, generational wealth, legacy, charitable giving, planning. All of these things require some sort of growth and accumulation strategy for the long term.
And the downside.
That good old volatility. We have to expose ourselves to some risk and volatility in order to get consistent growth. And this is one of those things I like to tell people: long-term gains come at short-term cost. There's a certain emotional anguish that comes with, watching your account go up and down over time. So you have
Right.
to kind of get used to and train yourself not to be so caught up in the day-to-day performance, and understand that in the long run, you are looking at a pretty steady incline in growth for the most part. And so you losing some of that liquidity in the short term and experiencing the volatility can be a bit of a roller coaster. What I tend to find is that people who have a well balanced overall portfolio, so they've got money serving all of these functions, tend to do better emotionally with watching the volatility that they experience in their investments with the effort to grow.
So you're talking diversification.
Absolutely. That is a key part of diversification. It's not just for the practical and functional performance of your portfolio, but it's also to help you get a grip. and and I say that because any financial advisor, any financial planner will tell you we are not immune to human nature. We're all susceptible to the biases and the emotional behaviors that we have in watching our money. So part of it is that we need to build a plan that takes that into account. Can we give ourselves somewhere tangible to actually touch money that will give us more security,
Mhm.
that will sort of be a buffer between our worst inclinations when the market is doing poorly?
Let me ask you, as people are going through their different life cycles, do you find that their deep interest, their constant watching of the markets and their investments, does it ebb and flow?
It may. It absolutely may. And a lot of it tends to be based on, I would say, their job satisfaction, their own sense of security in the short term. Some people want to sort of invest their way to early financial freedom, which requires some pretty aggressive maneuvering if you're trying to generate income from a portfolio in real time. And so people who are looking to do something like that tend to be much more wrapped up in the day to day. And they also tend to want to trade their own accounts and pick their own stocks to be much more aggressive to try to get those, they want to pick a winner type of thing.
Yeah, don't we
Um,
all?
yeah, absolutely. We would all love to. The
I,
vast majority of the clients that we work with tend to be much more focused on, I work for an income, I invest for long-term security
right,
type.
right. No, I was just thinking, as young people, you have the time to watch your portfolios and watch the markets. When you get into middle age and you have children you're raising, or you've got a household to run, you may not have the time to put in. And then as you get older, closer to retirement, it's like, whoa, 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 whoa.
Hmm.
Where is my dollar? What are my dollars doing right here?
Absolutely.
All right.
And that's exactly right. That's exactly right. It is again where you are in your life cycle, where your focus is, and you'll often see, people as their kids get older or something, they'll sort of emerge from the fog and say, "Hey, wait a minute. We should take a closer look at this." Things get pretty busy in there for quite a while, and then all of a sudden, the kids are at an age where they're not paying attention to you anymore, and they feel like they're doing everything independently, and you start to get back to your own stuff, and you're like, "Oh, I should probably look at my money."
That's
So,
it.
yeah.
Do you find that you have to help your clients set their goals and stick to them?
Yes, a big part of my responsibility as an advisor is to be an objective accountability partner. Again, people are living busy lives, and the vast majority of the people that we work with at Artisan tend to be very smart, very accomplished, and if they had the time, and they weren't living their life in their own careers, working with their families, doing things in their community, being active, they could probably figure out a lot of this stuff, but one, they'd be too close to it personally to see all of their own blind spots, which is
Mhm.
why a lot
Yeah.
of us tend to have our own financial advisors as well, because even with the technical expertise, we don't always see everything from every angle that we need to. Um, and then they also just need to have that outside accountability that can keep an eye on things while they're living their life. So, just be a reminder and a touch point, which going back to time, having a regular meeting cadence in when do we touch base to review these things to make sure that everything is still relevant and nothing has gone off the rails in one way or the other, or we're not going back to your point, being over indexed in a certain area. So do we have too much protection? Are we paying too much in insurance premiums across
Right.
property and casualty and disability and life? Do we need to cut something back? Do we need to add something on? All of these things are functions that a quality advisor is going to help you stay on top of.
All right, Adam, this is the second of your four-part series. We did money and time, money and function. Preview the next two for us.
So, next up, we are going to be doing getting in the market and staying in the market. And that is really about the importance of understanding that time in the market, everything goes back to time. Are you
Doesn't it
noticing
though?
this thing? Time in the market is more important than timing the market. So we'll talk about the importance of compounding interest, compounding periods, the amount of periods that your interest compounds in your portfolio over time, and talk about some tangible examples of the difference in getting started early, even with a small amount, and how much of an advantage it gives you over waiting and maybe thinking, oh, I'll be making a lot more money 5 years from now. I'll catch up then. So we'll talk about what the actual cost of waiting and getting into the market looks like.
That's three. What about four?
Episode 4, we'll be talking about protecting your downside. So we'll be talking more in detail about some of the issues that come up with insurance planning and risk management and making sure that people understand the importance of that.
Outstanding. All right, Adam. Adam Tolliver of Artisan Financial Strategies. How can someone reach you with questions or just even a comment?
Absolutely. If you want to learn more about working with me directly or getting in touch, you can go to workingwithadam.com.
And make sure you, listener, know when a new episode of Adam's podcast, The Business That Pays, is ready for you. All you have to do is subscribe. And your friends would probably appreciate it if you shared the podcast with them too. I'm Patrice Sikora, and let's talk again later.
Thank you for listening to Business That Pays. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of the Artisan Financial Strategies or Eagle Strategies, LLC, a registered investment advisor. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial professional provider with any questions you may have regarding your investment strategies.
Adam Tolliver, registered representative offering securities through New York Life Securities, LLC, member FINRA SIPC, a licensed insurance agency. 1125 Cambridge Square, Suite C, Alpharetta, Georgia, 30009, 404-210-9311. Financial advisor offering investment advisory services through Eagle Strategies, LLC, a registered investment advisor. New York Life Securities, LLC, and Eagle Strategies, LLC are New York Life companies. Artisan Financial Strategies, LLC, is not owned or operated by New York Life Securities, LLC, or its affiliates. Neither Artisan Financial Strategies, LLC, nor its advisors provide tax, legal, or accounting advice.